Welcome to The Explainer. If you've been following the massive artificial intelligence boom lately, you've probably heard the exact same story repeated on an endless loop, right? It's all about the giant tech names, the massive cloud providers, and of course, the reigning king of GPUs, Nvidia. But what if I told you that the mainstream narrative is entirely missing the real story? Today, we're going to look right past the software and the massive hyperscalers, and we're diving into the physical layer. Because the actual bottlenecks holding back AI, and frankly, the companies poised to define the next decade, are hidden deep within the industrial supply chain.
So I really want you to ask yourself a question as we go through this. Who actually captures the financial value of the AI boom? We have to look past the flashy giant tech names dominating the headlines and start looking for the hidden toll booths. I'm talking about the companies sitting at structural choke points, capturing the real financial surplus, because quite simply, you literally cannot build AI without them.
Here's a quick roadmap of what we'll be covering in today's explainer. 1. The AI compute bottleneck. 2. Massive incumbents under pressure. 3. Innovators in chip design. 4. The Rigaku packaging advantage. 5. Semtech's analog amplification edge. And finally, 6. Investment risks and rewards.
Okay, let's jump right into part 1, the AI compute bottleneck. Let's look at the massive physical constraints holding all this back.
Take a look at this AI token factory economics stack. It reveals exactly where margins are being captured across the whole ecosystem. Everyone is obsessed with the soaring, almost insatiable demand for AI tokens. But the reality? The physical constraints, things like memory, advanced packaging, and the literal electricity required to keep the lights on, that's where the real value bottlenecks exist. You can write all the brilliant software code you want, but at the end of the day, you're bound by atoms.
And this creates what we call a massive physical moat. Look, AI is fundamentally an industrial problem, not just a software one. To put this into perspective, building a leading-edge memory fab to produce high-bandwidth memory costs over $10 billion. You've got severe power delivery constraints and critical shortages of rare elements like indium phosphide, which are absolutely essential to build the lasers moving all this data around. Clean room capacity for new fabrication, it's effectively sitting at zero. These are not just minor supply chain hiccups. They are immense structural, regulatory moats and physical scarcities that are completely redefining where investment capital needs to flow.
Moving on to part 2, massive incumbents under pressure. The clock is definitely ticking for the giants.
There is a stark, almost scary contrast between the bloated expectations of the established incumbents and the reality they're facing. You've got giants like Nvidia and TSMC with these massive multi-trillion-dollar valuations. But here is the massive catch. Hyperscaler customers, think Microsoft, Google, Amazon, Meta, they make up over 40% of Nvidia's revenue. And these hyperscalers are spending mind-boggling amounts of cash. Microsoft is projected to spend up to $150 billion in capital expenditures to generate just $25 billion in AI revenue. That gap is completely unsustainable. So to salvage their own return on investment, these hyperscalers are aggressively building custom in-house chips, like Google's TPUs or Amazon's Trinium, just to create credible outside alternatives and force Nvidia's prices down.
As one analysis perfectly summarized it, when the spending eventually rationalizes, the first cost to be renegotiated will be the hardware supplier commanding the highest margin. So Nvidia's incredible, industry-leading margin, it's essentially a giant target painted on its back. And that creates a beautiful opening for agile competitors.
Which brings us to part 3, innovators in chip design. This is where we see some incredible David versus Goliath dynamics. Let's compare general-purpose GPUs like the Nvidia H100 with an innovator like Taalas. General GPUs cost around $25,000 to $30,000 per chip. They're highly flexible, sure, but they require massive amounts of memory and rely on heavily bottlenecked advanced packaging to function. Taalas, on the other hand, is doing something totally wild. They are hard-coding fixed weights directly into the physical silicon itself. They trade that broad flexibility for just incredible speed and massive cost savings. I mean, they shrunk a one-year design process down to a single week, and it takes just 2 months to fab. Because it's hard-coded, it requires zero memory and zero advanced packaging. It's dirt cheap. If the AI models stabilize enough to start relying on fixed weights, this economics model is absolutely untouchable.
Then you have Cerebras. Look, the biggest bottleneck in traditional computing is just getting the data off the chip package. It's a huge traffic jam. Cerebras solves that interconnect bottleneck entirely by keeping all the data physically on a massive wafer-scale engine. It's essentially a chip the size of an entire silicon wafer. Because the data never has to leave that massive wafer, their processing speeds are astronomical. And this isn't just theoretical startup talk. They're already securing massive, multi-year server shipments from major players like OpenAI.
All right, part 4, the Rigaku packaging advantage. Let's look at one highly specific, crucial bottleneck.
As chips get smaller and insanely densely packed, the industry is shifting to 3D architectures like gate-all-around transistors. The problem? You literally cannot see through these complex new materials with traditional optical light. It's like trying to look through a brick wall with a regular flashlight. Enter a company called Rigaku. They provide high-end X-ray machines for inspection. What used to be a niche piece of lab equipment used strictly for R&D is suddenly becoming mandatory on the full-scale production line. Because tolerances are so tight, you physically have to pass your product through Rigaku's X-ray machines to even know what you're building. Talk about an ultimate toll booth.
The situation here is so stark that an industry analyst actually pointed out, and I love this quote, Onto knows they're screwed. They go and buy a quarter of the market cap of the company that can make the machines, Rigaku, and are just selling software on the side. Seriously, think about that for a second. Rigaku's own competitors are literally buying into Rigaku's stock because they know they've completely lost the hardware race.
Section 5. Camtek's Analog Amplification Edge. This is another hidden layer of the AI stack most people totally miss.
When we talk about networking, it's not all just digital code and logic. Camtek operates in a virtual duopoly making analog amplifiers and equalizers. These are physical, hardware components required to boost electrical signals so that data doesn't degrade as it travels over cables and circuit boards. And they're capturing roughly 90% of the market right now. Why? For the simple reason that their parts are objectively, demonstrably better than anyone else's.
So the crucial takeaway here is that Camtek isn't just a copper play or an optics play. Their analog amplifiers are required in virtually every single piece of hardware moving data around an AI data center. Camtek is the ultimate agnostic winner. No matter whose chip architecture ends up winning, whether it's Nvidia, Google, or AMD, Camtek's analog parts are required to amplify the signal.
Let's bring all these threads together in Section 6, Investment Risks and Rewards. When we evaluate the investment strategy out there, we're seeing a really clear shift. The highest risk clearly lies with AI model labs that have completely undefined valuations and compute incumbents trading at massive price-to-earnings ratios, meaning their stock is already priced for absolute perfection. But the smartest money? It's moving away from that crowded trade and toward essential infrastructure players. Take Micron, for example, which controls a massive chunk of the high-bandwidth memory market but trades at a highly moderate PE ratio. And even more fascinating are the deep-value power plays. We're talking about companies that might even look distressed on paper right now, but they physically hold the keys to the electrical grid.
Because here's the secret. The real bottleneck isn't even sitting inside the data center anymore. It's sitting right outside of it, the power grid. Companies like Wolfspeed, which recently emerged from bankruptcy, have developed a revolutionary 10-kilovolt silicon carbide chip. It's essentially a super buff transistor capable of handling the insane voltages coming off the electrical grid to feed these hungry data centers. We're also seeing former solar companies like SolarEdge and Enphase smartly pivoting to build solid-state transformers to regulate all this power. These are highly leveraged, high-upside plays that the broader market is just completely ignoring right now.
As the analysis from our source material so perfectly summarized, those who own the boring industrial backbone today will own the intelligence of tomorrow. We have to remember that artificial general intelligence is, at its core, fundamentally a physical and industrial problem. It is not just a software problem.
So, I'll leave you with this final thought. When the relentless hype around the latest conversational software models finally cools down and the market rationalizes, will your understanding and your portfolio be based on the models that change every 2 weeks, or will you own the industrial, physical backbone that runs every single one of them? Thanks so much for joining me for this explainer, and keep looking for those real bottlenecks.